Good morning. S&P 500, 8/6 of 2011. Today's topic is how new bear markets start to develop. And what are the patterns of a new bear market? And what would be the trade management intraday? And what has been the 2-week reversal, as this is an S&P weekly chart. And we can clearly see that from the high of the S&P was 1344, and this second weekly reversal down here coming to its moving to test its weekly moving averages. That's a 200 week, that's a 100 week, that's a 10 week, and a 20 week. So as we sold through the 50 week, we increased, and we've come down to a 100 week and the 200 week. Now, granted that that's 176 S&P reversal points from this was the long-term reversal that we called back in May of 2011, and that the length of that reversal meant that any counter rally in the summer, as we had, was going to fail, and it was going to be miserably fail. And it was all because of how weakness is built. And this right here is setting up what we would call a bear, not just a bear reversal, but a bear market. From a bull trend to another bear. So the bear has been here since 2000. It never left. We had bull rallies throughout the long 11-year bear. And we're setting it up. We've had time for this bull rally to build some legs in it, because it did. That meant that when we got to the top, that buying the dips were good throughout this whole time when it started. That was a really nice rally up here. That was 2 years. And you have bull rallies in long-term bear markets. That's the way markets are. This weekly chart, that MACD, when it pops that sell signal, here's what happens. Look at over here in 2008. Weekly sell signal, I'm talking. We're about there. When we had the 2010 pullbacks in here, we had slightly. But when they get nasty, man, they can get nasty. Now, do I see that coming in this calendar year as deep as this? No, I didn't say that. Because it takes time. However, when we hit that, it's where this rally, bull rally, starts its original bear. Again, goes in, bear comes out of hibernation. And these declining weekly moving averages have a way of showing where the strength and weakness is. So every time the S&P leadership stocks go up and hit their highs, they're going to roll over. We've been doing that for the last month. Now, when you look at a daily chart here, so let's blow this up, MMTs. You can see here, and let's take the trend lines out so you're not confused. You can see here on a daily, which is a shorter time frame, versus the weekly. The weekly is always going to be what we, look for longer term analysis. But you can see over here for the new people that when these moving averages start to descend in value over here on the S&P, when they were going up, man, we were burning. Look at these 10-day moving average and the 20 rising in value all the way up to the 2011 first high. And they kind of retracted a little bit, but they recovered right away, and we ended up making higher highs. And in the last rally, using shorter time frames, is that we took out all of the lows right here, the long-term neckline for 2011. And the reason why is that the simple daily moving averages had crossed over the 10 over the 100. You got the 10 crossing over the 200-day simple. You've got the 20 crossing over the 50. You've got the 10 over the 50 and the 40. What happens is these turn first. the down movement that we've had here, when you take a look at the weekly over here, here's the weekly now. That's the weekly S&P. Is as this had hit its peak and started to descend on a weekly, that meant that the upside volatility was to be so short. And why were we so good about what we were doing is that we've done enough of this over the years to know when markets change. And that there is a time stamp. And that the volatility increases in the S&P at very high extreme levels when either a new bull is born or a new bear is coming back. There's always that volatility increase. It gets to such levels. Bull markets are extremely volatile when they're going to get reborn. And bears are extremely volatile when they're getting reborn. The thing about it is that the amount of selling that we've had, 176 points. These weekly moving averages, that's 100 week. That's where they came in and bought it. The 200 week is very significant. We will come down and bounce on these things. That's where they're going to get that support level, and that's where you'll buy the bottom up side. But the bottom up side isn't something that I'm wanting to buy and hold. No, it's something I'm going to buy and sell it back to the public, like we do. However, because the new bear is starting to come out of, out of hibernation, is that we will have, on a daily level, we will have support levels. It's got a daily sell signal right here. And in the shorter term, you get these pops back up, but they're going to fail and make another lower low, because you get short-term oversold. That's when you get that upside. And you could get 3 days up to resistance, and you roll over and make another lower low, like you did over here. You came right up here, you rallied up, you pulled back, and then you rallied up 1, 2, 3, 4 days up to the top. But you've made a lower low, like I said we would. And we have. And we will remain the same trade management that in August and September, especially in August and September and October, is that any upside volatility is where the put side of the market is going to be viable and profitable. And when we start to break down here on the weekly level of the S&P 500, and when we hit a weekly sell signal, this is a daily sell signal, and we have sold down really hard. And one thing about oversold markets, they can stay oversold for months, weeks and months, like they were doing since 2009. But a bear can stay oversold for days, weeks, and months. And that the bottom upside trade is always there, but it's not something you want to fall in love with and hold it. You want to come out of it and get right on the other side of that trade, short, because they're going to fail and they're going to make lower lows. And all of us enjoyed the rally here that we called off the bottom, but then we pulled back and we didn't break the highs on this daily S&P right here. See, let's make sure that you know it's daily S&P, weekly S&P. And why were we going to make lower lows? Why did I say we were going to make lower lows? Why would I know we're going to make lower lows? How could I be so bold to tell MMTs that we're going to make lower lows? And that the highs would fail, and that the upside volatility intraday was to be sold short all the way down, and you were here for every single day of it. Why is this low going to make a lower low? Does it have to make the lower low on Monday? Yeah, it will. Or it'll test it. But why will it make a lower low? Why did this low here make a lower low? When we were rallying, we loved that. But then, when we pulled back, the failure started right here on the third day down. And when these daily moving averages started to turn over and go down and cross over in value, that's why. The most important part of the analysis was that this weekly trailing 10-week moving average up at the top had peaked. Here, let's do the math. Right here, that 10-week moving average on the S&P was 13, imagine this, 1333.73. 1333 was the peak. When you look at today's 10-week moving average in value, you're at 1294. MMT, do the math.
Because I'm on mute.
1333, it's okay, you can talk, minus 1294 equals 39 points. That 10-week has fallen, and that's a good size number from its peak to here. It's fallen 39 points in value, which would mean that this market, this bear is building, because when you start declining that much in weekly moving averages, like a 10-week, it's forward looking as why we're going to come down. So one of the things about it here is I'll draw a trend line right here. That's 1125 on the S&P. That's even below the 200-week. This particular one right here at the green line, the 200-week, is about 1158. The long-term bull rally is no longer in play. Everybody that could buy the dip when these weekly moving averages were going up in value, man, it was all about buy the dips, man, buy the dips, buy them pullbacks. That's what we were doing all that time, because these were rising in value. And as they got further apart, the 10 and the 20 week, that meant that every pullback was buyable, as always, and always come down and hit the lower rising 20 week and made another high. We went through the whole thing. We called that correction there, we called this one here, and now we are in a third correction. The third one is always going to be the one that has the most downside to it, no matter what. You can see here that the weekly drop in the S&P is about 176 points, and the declining weekly moving averages in the 20 week is starting to turn over. You sold through the pink line, that's the 50 week, and they got, and you know, these longer term weekly moving averages, you know, they get support, and they bounced on Friday because it's its first pass. The first pass on the 50 week blew right through it. The upside volatility is to be selling short. How do you confirm it that a bear coming out of hibernation? It comes, so it's been hibernating a long time, a couple years. It's had its little bear pullbacks, but it didn't, you know, it stayed, it was really not out of it been hibernating. Not now. Problem with investors, investor traders and whatnot, I don't know how to decipher it. Because every time they get an up move, they think that, hey, it's the same as it was during this bull over here. This was bull. This is bear. See how the bull started over here on a weekly level in 2010? It crossed above it right here, the 10 week. Well, we're just now going the opposite way. First pass at 100-day, 100-week, or 200-week always acts as the major support levels on their first pass, for the most part. The 50-week blew right through that 50-week. So when we used a shorter time frame for oversold or overbought, is that the daily is telling the picture here. And we are going to get sold out where we get the upside volatility, but that upside volatility will be sold short. So if I'm going long the index options over here, yes, it might be intraday for a couple of days, 2 or 3 days, but ultimately the bigger trade is going to be buying the put options, and these things are kicking ass. I mean, if you take a look at the 1320 put here on a weekly level, my friends, it's inflated, So that, but these were, and I covered these with my MMTs, and I'm once again MMT. You know, you got to go through, you know, part of your apprenticeship, but the contract was $14.70. My friends, this contract is $121 if you invested $14,000 in the put side, because you understood what the S&P was doing over here on a weekly. That's a $100,000 freaking trade. Bottom line. Now, having said that, it's inflated. That means that on the weekly S&P over here, we could have some upside volatility. It'll go back, though. These are going to pull back because they're inflated. They've ran and broke out extremely hard, but they're going to pull back. That's a $100,000 trade on $14,000 by shorting the index options on the S&P 500. And here it is now. The truth, let the truth be known. As I always say, ring the register, but why would I know? How could I take a $15,000 investment and make it well over $100,000 in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days? That's pretty good yield. That's like, well, do the math. That's like $10,000 a day. So when we look at put to call ratio, the put is inflated, and when the put to call ratio gets out of whack, that means that in the shorter term, on this daily chart down here, we're going to get oversold. We will bounce up, but the rally will fail, just as that rally that we did here failed to here. That means that when we get ready to get net long, we'll take it up in the volatility. We'll make some money that way, but then it's going to make a low. In the short term, when I look at put to call ratio and I look at the amount of drop on the moving average, convergence, I look at the weekly support levels that are temporary, is that in the shorter macro, we're going to have upside volatility and rollover Beethoven. And the upside volatility, when it does happen on a big short squeeze, you will have that upside volatility just like we traded here. It started, double bottom, and whipped it, pulled back, but we made a lower low from that summer rally, and the same thing will apply in August and September, and we will go up, and we will hit a reversal again, like over here, because we are going to get oversold in the short time frame. And the put to call ratio on the S&P 500, as you can clearly see, MMTs, these were up here at the high of $125 a contract 1, 2, 3, 4, 5, 6 days ago. That's a 1,220 call that was written in the options. They wrote them up here at that price, and then they've taken the premiums all the way down here to $11.80 on Friday, and they bounced. The high was 24 and the low is $11.80 now. Nice trade intraday. Now, when you take a look over here of a 1320 put, it's at $121, and this is at $120. The put to call ratio in a shorter macro is that that's inflated, and these are getting down into the deflated area, and that this side of the market in the shorter macro isn't going to stay up there. They're going to have to come down in value, and these are going to have to go up. And that the bottom that they opened, the opening was $24. The bottom that got put in, the low on Friday, was $11.80, but look at where they closed. They closed at $17.80. 10 of these contracts down here, when we do get ready to move up on the S&P, are buyable, but they're not to want to hold and be in love, because they're not going to have, the call side isn't going to do what this put side did. I mean, this was dirt cheap. 10 contracts down here at 14, so you paid, say you bought 10 contracts, $15, it's well over 100 grand. And now on the flip side, that we're going to be buying down below the market on an intraday level, because the ratio between the two, deflated versus inflated, is where markets turn only in a 5-day, 1-day, 3-day, 5-day, 7-day, 10-day period. So as we get back over here, just remember that you're going to want to set your alarms and trade this. And I can tell you that when the highest volatility is here, these are big monster trades. S&P 500, we've gone through the daily chart. This is that daily chart, and we're getting a little bit oversold in the short term. And at some point, we're going to have a relief rally like we did over here. Just the way that the volatility is. That was your rally and your lower low. And basically, we brought the trend line on the S&P down to that undercut 1180, but that's where this is where that support level is over here, where we burned, and the bull rally was buyable. It's different today, but it was buyable here, because that's, you can see right there where that wick hit, but you can see that we made that high. That's that high, and from that very same area here, that was the first 2011 high, the second 2011 high from here, and let us not forget to that reversal high right there. That was the all-time high. That was a reversal, and this is where that bull rally started, and we traded it up. But here, you can clearly see that every time we got up here, and even though that rally happened, it was a tradable rally, but it made a lower low. And we know why, because we're using the weekly chart on the S&P. And we're going to be taking a look at the timestamp when that short cover rally sets up, that the rallies go up, but they fell. When we hit the bottom here and we rally up, we know we're going to fail, and that the shorter neckline is going to be right here. That's going to be half of that daily bar or so right in there. But the neckline will be right up here at 1250. And you can trade up to 1250 and then roll over. Why? Because the new bear has started, but put to call ratio is out of whack. And this call contract right here, that 1220 call, pays a lot of money when we get the intraday entry here, and we come down and we hit that support and we do rally up. This is going to make another lower low, so we have to be selling the call and then buying the put. And the S&P technical damage is in play, and this is the daily chart. We showed the weekly. The monthly chart on the S&P, you can see that the monthly key moving averages are right here. And they're holding a 100-month and a 40-month, but they're below the 10-month. And last time in 2010, when we made that high, we got back above that 10-month. That 20-month is always the underliner, just like the 20-week or 10-week. But the monthly moving averages now are very, 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 very powerful. And we've come down here and we've hit it, and it's acting as, you know, a support level. But when we break below it, we can rally up and come down and break below it. And that monthly reversal outside of the weekly that I showed you is that eventually the monthly moving average will start to go down in value. It's no longer going up in value. So these rallies that we get, we're selling it and buying short again and again and again and again, because the bear is out of hibernation on the S&P 500. MMTs, add this to your video library for next week's trade management. I want you to put the $1,220 call up and out of the money. We gap down on Monday. It's going to take that contract that was at 1180 that I showed you down to about 560, and we'll get that lower price, and it'll bounce and go back up in value. And that index option, they'll steal all the premium out, and on the opening bell we'll purchase.